Hi everyone. So welcome to the stream today. Very much excited for having you once again on the day 3 of our executive revision masterclass, where I am focusing on key areas of the syllabus and look at specific topics in various subjects to be able to assist you in order for you to prepare for your examination. And today we are looking at one of the critical topics when it comes to corporate reporting and financial reporting, and that is financial reporting standards. We're going to be looking at a couple of IASs and IFRSs and how you can use it in order for you to prepare for your examination. So if you're writing your ACCA F7 or your SBR, that is the strategic business reporting, or you're writing financial reporting, or you're writing advanced financial reporting or corporate reporting in ICA, this is something that is going to be very critical for you in relation to that. So if you join the stream, you know what we do and how we do it. Give us a thumbs up on the video and also comment in the chat box with all of your questions. I'm going to be answering all of your questions, reading your comments live as well here, so I could answer your questions for you and provide you with some assistance. So we're going to be looking at a couple of the financial reporting standards today. I'm going to be providing you with some guidelines on the various things that you need to do and the various things you have to focus on in order to increase your chances of ultimately passing the exams in relation to that. So if you join the stream, if there is any accounting standard that you have questions on, you can put it in the chat box. I'm reading all of your comments and I'll be replying to it. So whatever standard it is, IFRS 16, IAS 12, IAS 16, IAS 20, IAS 23, IAS 36, IAS 37, IAS 38, IFRS 5, IFRS 2, and all of the accounting standards. So just put it in the comment box. I'm going to be looking at all of your comments and I'll be replying to them in relation to that. So give us a thumbs up on the video if you join the stream, and then you comment in the chat box with all of your questions as we get into today's discussion. Remember to also share the video on your WhatsApp platforms and your Facebook groups and others, so that we get many people coming on to watch the stream in relation to that. Now, like I say all the time, if you're writing financial reporting or corporate reporting, one of the critical areas you have to understand is the issue about accounting standards. So whether you like it or not, there is going to be a question in the exam hall for the accounting standards. All right, Richard AJ, I see you with a thumbs up in the chat. You are welcome, and I believe you're doing very well in relation to that. Give us a thumbs up on the video as well itself on the page, and also share with people so we get more people watching the stream in relation to that. Now, why is accounting standards very, very important? Because I see accounting standards as the language of the financial statement. So in order for you to understand the assertions on the face of the financial statement, what constitutes revenue, what constitutes cost of sales, what constitutes administrative expenses, what constitutes distribution expenses, what is an asset, what is a liability, how do we recognize inventories. To be able to really prepare the financial statement and understand how the financial statements are prepared, we must first understand what the accounting standards. And there are a lot of accounting standards that we need to understand in order for us to prepare well for our examination. Now, if you're writing corporate reporting or financial reporting, let's start from there. We know that there is a standalone question that we are going to be having on the standards. So I see Foster Bashios as well, giving a thumbs up in the chat. Thank you very much. I believe you're doing well as well. For all of you that were watching, if you have any questions on any specific standard you want me to explain, put it in the chat box. And then whatever question you have about that particular standard, you can put it in the chat box. I'm going to be reading all of that and we'll be answering that for you in relation to that. And also remember to subscribe to the channel if you have not subscribed to the channel in relation to that. So if you are writing corporate reporting, one of the critical areas that you need to understand and look at is the issue in relation to the accounting standards. So like I mentioned earlier, we're going to have a standalone question on the accounting standards. Usually that's going to be maybe question 2, depending on the examiner's arrangement. So that is going to be on accounting standards. And then when it comes to the question 3, which is going to be the single entity financial statement also, every footnote, okay, it's going to be an accounting standard. That is why it is very critical for you to understand all the accounting standards. So if you pick the statement of profit or loss, or the statement of the income statement and the income statement and the other comprehensive income, you pick the statement of changes in equity, you pick the statement of financial position, you pick the statement of cash flow, all of those financial statements, in order for you to prepare them well, you must understand the accounting standards, because the footnotes and every adjustment that must be done will be based on an accounting standard. Then also, there will be a standalone question on the accounting standards that the examiner will throw at you, that you have to be in a position to be able to answer that. Now, if you are doing corporate reporting, we know certainly there is going to be a standalone question as well on the accounting standards. So it's very, very important for you to understand the accounting standards. Not only that, in the question 5, where I call usually as no man's land area, there is going to be a question on ethics in the question 5 corporate reporting. Then the rest of the question could be on conceptual framework, regulatory framework, as well as on the accounting standards in relation to that. What it means is that you stand a chance of really increasing your chances of passing the examination if you actually learn and understand the accounting standards very well. Ebenezer Hatta said, hope I'm not late. Yes, Ebenezer, you are not late. We are just getting started and giving some background introduction real quick on that. So that is why it is very, very important for you to understand the accounting standards. Now, the way I want you to go about the accounting standards is also not to chew them, okay? Here we can't do Baba on the accounting standards. Francis O2, I see you with a thumbs up in the chat box. Welcome, I believe you are also doing well. So it is not about chewing Baba. You don't chew the standards Baba and go to the exam hall. There are concepts, principles, fundamental basics that you just have to understand about the accounting standards. Practice a lot of questions, then you will be in a position to solve every question. Remember, if you're writing corporate reporting or financial reporting to be specific, there is going to be a standalone question on the standards. In addition to the standalone question, to be able to prepare the single entity financial statement, whatever single entity financial statement the examiner asks you to prepare, definitely you are going to be needing the accounting standards. That is why I'm taking my time to be able to go through some of the accounting standards with you, so you can be able to be in the position to address this question too confidently, as well as prepare the single entity financial statement. So if you are watching, then there is a standard you have question on, put it in the chat box. I'm going to be reading all of your comments, and also give us a thumbs up on the video. That way it gets more engagement, and YouTube will be able to push it on the platform so that other people will be able to watch it as well. If you're not subscribed to the channel, also hit on the subscription button and the bell notification icon, so that if I go live or we release new content, you'll be the first person to be notified in relation to that. So let's get into our discussion. So when it comes to the accounting standards or the financial reporting standards, there are what I call core accounting standards that you have to understand. In other words, before you walk into the financial reporting exams or corporate reporting exam, you must understand these accounting standards. No negotiation. Now, why is this important? Because you see, not only for the exams, but also in practice. Because when you finish, you charter and you are supposed to do something, you're going to be applying some of these accounting standards, but in an advanced way in relation to that. Because what happens in the office, in the corporate world, it's going to be a bit advanced, but these are going to be the basics for you to be able to go through there in relation to that. Because if you take an accounting standard like IFRS 16 leases, there is a higher level of the leases, which per your syllabus outline, you're not supposed to know that. But when you go in practice, you are going to be learning that, but the basics are going to be this one in relation to that. So what are the core accounting standards that we need to focus on? So let's look at some core accounting standards. So what are these core accounting standards that we need to look out for? As always, IAS 2, inventory. Maybe let me not write their names down. Next one, IAS 8, accounting estimates, change in accounting concepts and errors. Then IAS 12, income tax, regular customer. IAS 16, property, plant and equipment. Whether you like it or not, it's going to be there for you. IAS 36 and his brother 38, impairment of assets, intangible assets, very fundamental for the syllabus. Then we need to also understand the issue in relation to IFRS 15, revenue from contracts with customers, very fundamental, very critical. You need to understand that. Then IAS 37. But let me not even talk about IAS 37 as, okay, let me just put it down. So before you get to the exam hall, as far as you are writing financial reporting, you must have basic IAS 2, what is it about? IAS 8, what is it about? IAS 12, what is it about? IAS 16, what are we talking about? IAS 36, IAS 38, what are we talking about? IFRS 15, revenue from contract with customers. IAS 37, provisions, contingent liabilities, contingent assets. Now, help me to be more productive here, all right? So what standard would you want me to talk about really today? So put it in the chat box. If there is any standard you have difficulty with, or there is a question you have under any of the standards that you want me to talk about or throw more light on, put it in the chat box so that I can pick those ones out and then assist you better. So if you're watching, put it in the chat box, what kind of standard you want me to look at today. Maybe you have a question in a specific standard, raise it up and I'll be able to assist you in relation to that. So IAS 2, IAS 8, IAS 12, IAS 16, IAS 36, IAS 38, IFRS 15, revenue from contract with customers, IAS 37, provisions, contingent liability, contingent asset. But this is the sweet spot. Even though these are the core accounting standards, okay, so I see some comments already coming in. Ebenezer Atta said IFRS 15, okay. Then if I mention your name wrong, please forgive me, okay. Linduela Fungula, something like that. Let me just stay with the first one so that I don't have a problem. Linduelwa said, IAS 36, can you please help us how we can calculate the impairment loss reversal? Okay, impairment loss reversal. Okay, then I see another one. Foster Bashir said IAS 23, that's borrowing cost. Then John Edu said IAS what? 7 for banks and insurance companies, format explanation. Okay, so cash flow statement pro forma for banks and insurance companies. Okay, okay. Any other? Put it in the comments box. I'm gonna be addressing them in that order. Ebenezer also said IAS 16 as well. Okay. Any other? We're going to be structuring all of these out and he will be able to give the explanation. Okay, so let's get going. Now, so before I go into some of the standards you've listed, then Lindwelwa said IFRS 15, IAS 12. So I'm getting two people raising concern on IFRS 15, that is revenue from contract with customers. Richard Opoku Ajiman is saying IAS 13. And then Richard AJ said IFRS 15 and IAS 12. Okay. So I guess we are getting more issues on IFRS 15. And then IAS 13, the issue in relation to fair value measurement. Okay, that's good. Any other? Joseph Udam, detailed explanation of IAS 12. Okay, the way you said detailed explanation, okay. So we're gonna be going through them real quick. Now, one thing you must also understand is that I have lecture videos on almost all the standards already on the channel. So if you check after the stream, if you check the channel page, that is the playlist is accounting standard series, I guess. Let me just confirm. Yes, accounting standard series. That is a playlist. As of today, there are 44 videos in that playlist, and I covered almost all the accounting standards that you are asking me about here, but I'm going to be touching on the ones that we've mentioned as well here in relation to that. All right. Now, when you are doing IAS 16, property, plant, and equipment, there are some standards that are connected with it. And so you must know about those standards. The first one is IAS 20, government grants. The second one is IAS 23, borrowing costs. So if you are doing IAS 16, one of the key things you must understand is what? IAS 20 and then IAS 23, borrowing costs, because they are closely related with that standard. And then the third one is going to be IAS 40, investment property. Actually, these four standards, that is the IAS 16, IAS 20, IAS 23, IAS 40, they are together called the non-current asset standards. So because all of them deal about the accounting standards, sorry, the non-current assets in relation to that. Okay. Any other standards in the chat box, let me know. If you're watching, give us a thumbs up on the video. That way it gets more engagement and YouTube will be able to push it for others to be able to watch as well. And then you can share. If you have not subscribed also, come on now, hit the subscribe button and let's go. All right, so let's get into the discussion real quick. First, we're gonna be having, okay, I see Bernard Kobena coming in as well. So let's start with a discussion, IFRS 15 real quick, and then let's go through IAS 12, income tax is also there. I think 3 or 4 people are talking about that standard as well. So let's get into them. Right, so let's go to IFRS 15, revenue from contracts with customers. Now, this standard is actually replacing 2 basic accounting standards here. Okay, I see Bernard Kobena said IFRS 10. Okay. And then also Francis saying IFRS 15, sorry, IAS 15 and 16. IFRS 10, I think definition of, is it definition of control, I guess, yes, on consolidated financial statements, yep. Okay, so let's get into the revenue because IFRS 15, many people are coming up with it. So let's go. So this accounting standard, IFRS 15, is actually replacing two accounting standards. That is IAS 18, revenue, okay? And then IAS 11, construction contract. Now, what was the problem here about that? You see, under IAS 18, entities were recognizing revenue when they hadn't really undertake the work or done what they are supposed to do under the contract. In the context that, for instance, if my year ended is 30th September, every year, 30th September, maybe I sign a contract on, say, 20th September. So I sign a contract, I have not started the job, but what happens is that I receive the money, so you pay me the money. The average entity actually recognize the revenue because the transaction has actually taken place. Because under IAS 18, we recognize the revenue when the transaction takes place. But you see, the fact that the transaction has taken place does not mean we have actually done the work. So we will be adding the contract that we received on the 20th September, the money that we received to the 30th September year ended revenue. But the actual work is going to be done in the next accounting year. So you realize that what will happen is that in 1 year, the entity will be having more revenue. So revenue will be overstated, thereby overstating profit. And then in the following year, revenue is understated and profit is understated. So it is this discrepancy of receiving the money but not doing the work yet, or maybe doing the work yet and not receiving the money, and how the recognition of revenue has to be done. That was why the IFRS 15 was developed. That is the IFRS 15 revenue from contracts with customers. So with IFRS 15 revenue from contract with customers, we say that revenue is recognized by following what is called the 5 steps framework. So the 5-step framework for revenue recognition. So if we want to recognize revenue, we follow the 5-step framework. Now I'm going to list the 5 steps down, and then we're going to be taking them one after the other. So the first thing is that we need to identify the contract with customers. So identification of contracts with the customers. 2, we need to identify the performance obligation. Number 3, we need to determine the transaction price. Transaction price, TP. Number 4, we need to allocate the transaction price to performance obligation using the standalone price. And then number 5, we recognize revenue as and when a performance obligation is satisfied. So these are the 5-step framework used in the identification or recognition of revenue under IFRS 5. Now, remember, the examiner can ask you to explain these, okay? So number 1, we identify the contract with the customer. Number 2, we identify the performance obligation. Number 3, we determine the transaction price. Number 4, we allocate the transaction price to the performance obligation using the standalone prices. Number 5, we recognize the performance obligation. Sorry, we recognize revenue as and when a performance obligation is satisfied. So these are the 5 key steps we go through. Right. So now let's take them one after the other, and then let's explain them a bit detail. If you have any questions, you put it in the chat box, okay? So number one, identify the contracts with customers. So when do we say there is a contract with a customer? The standard states that there are certain features must be present in order for us to conclude that there is a contract with customers. Okay, certain features must be present in order for us to conclude that yes, there is a contract with a customer. Very, very important. The first feature is that the contract is approved by all parties. Okay, the contract is approved by all parties. By all parties. So if you come to me, Nhyira, I want you to teach me for 2 months. And I said, okay, yes, I can teach you for 2 months. It means we have approved the contract. So you wanted it, I'm ready for it. So if you come to me and say, boom, Nhyira, I want you to teach me, and I say yes, it means the contract is approved by all the parties who are affected or who are associated with the contract. The second one is that the rights and payment terms can be identified. The rights and payment terms can be identified. Let me rub the button here. The rights and payment terms can be identified. That's the second thing. So we see everyone's rights. What is your right under the contract? For me to teach you, what is my right under the contract? You're going to be paying me. How is the payment going to be? Okay, you pay all before we start the class, or you pay 70% before we start. After 1 month, then you pay the balance. So the right and the payment terms can be identified in the contract. Then we say there is what? A contract with a customer in relation to that. The third one is that, most important, the contract has a commercial value. It just link up to the first one. So the contract has a commercial value. Meaning it shouldn't be a free contract, okay? It shouldn't be a free contract. There should be a commercial value associated with the contract in relation to that. So I say that, or you say, Nhyira, teach me for 2 months for the ICAG exams. And I said, okay, I'm going to teach you for 2 months and I'll charge you $10,000. It has a value, okay? It should have a commercial value in relation to that. And then certainly the last thing is that it is probable that the revenue will be collected. Above all things, this is one of the critical conditions to identify the contract. So it is probable that the revenue will be collected. It is probable that the revenue will be collected. These are the 4 conditions that must be present for us to say that there is a contract with a customer. That's the first point. Now, why is the last one important? Because there are times, if you come to me and say, Nhyira, teach me for 2 months, then I say, I'll charge you $10,000. And you said, okay, I will pay. I should be able to assess whether you can afford the $10,000 as a business. Because if you cannot afford, then there is no need for me to identify the contracts. It means I may teach you and you will not be able to pay. So the company should have the ability to ascertain the probability of the consideration or the money of the contract actually being received in relation to that. If the contract is approved by both parties, the rights and payment terms can be identified. The contract has a commercial value, and it is probable that we can receive the revenue under the contract, then we say that the step one is qualified. There is now a contract with a customer. So that's the first step. That's the first step. After we identify the contract with a customer, we go to the second step, and that is going to be we identify the performance obligation. Then I want you to follow me carefully here with the kinds of illustration I'm going to be using to build up our understanding here very well. So let's go to step 2, identify the performance obligation. So 2, you identify performance obligation. Performance obligation, it's PO, okay? So what is performance obligation? The performance obligation simply refers to the goods or services to be transferred to the customer in return of the consideration to be received. Listen to that carefully. The performance obligation is the goods or services to be transferred to the customer in return of the consideration to be received. So if you come and you say, Nhyira, I want you to teach me for 2 months, what will I do under the contract? That is called the performance obligation. So maybe under the deal, I'm going to be teaching you. Maybe under the deal, you're going to be getting my books. Maybe under the deal, I'm going to be doing an executive revision masterclass with you. Maybe under the deal, I'm going to be assisting you in your registration. Okay, so these are the performance obligation. What will the entity do or give or transfer to the customer in return for the consideration? That is the performance obligation. If it is a telecommunication company, on the other hand, that I have signed a contract with for them to provide me services, then what would they be doing under the contract? They would have to give me an internet service, okay? And then possibly as part of the deal, they are supposed to give me a device, maybe a modem or a telephone. So they are supposed to give me a device, then that becomes the performance obligation. So you realize that it can be service or it can be goods that is being transferred to the customer in return of the consideration we are receiving. So the second step in the revenue recognition procedure under IFRS 15 is to identify the performance obligation. What the entity will transfer, the goods or services the entity will transfer to the customer in return for the consideration or revenue to be received. That's the second thing. No P, no cost for alarm. I believe we are getting the principle so far. Then we go to the step 3. Step 3 is to determine the transaction price, TP. And this is where the journey starts to become very exciting. So make sure you stay with me carefully here. So step 3 is to determine the transaction price. So you determine transaction price. What is the transaction price? The transaction price is simply the consideration received or receivable under the contract. The transaction price is simply the consideration received or receivable under the contract. So if we go back to the illustration I gave you, you said I should teach you for 2 months, and I said I'm going to charge you $10,000. So that $10,000 becomes what? The transaction price. So that's simple. How much the entity is going to be receiving under the contract will be the transaction price. So step 1, we identify the contract. Step 2, we identify the performance obligation, what the entity will be doing. And then step 3, we determine the transaction price. Now, after we determine the transaction price, this is where the journey becomes very interesting. So I want you to stay with me closely here. I'm going to put this transaction price somewhere below here. So I'll be using it for my computation. So our transaction price is $10,000. Remember, I gave you performance obligation of 4 items as well. So after we determine the transaction price, that is the amount received or receivable by the entity under the contract in exchange of the goods or services transferred to the customer, we go to the 4th step, which is the crux of the standard. So step 4, we say that allocate the transaction price to the performance obligation using the standalone price. Using the standalone prices. I want you to stay closely with me here. And this is where some students have problem with. So make sure you understand it very well here. Allocate the transaction price to the performance obligation using the standalone prices. Now, with my illustration, we said that the standalone prices could be, the standalone price is simply the price we will charge for all the performance obligations separately under the contract. So if we go back to my illustration with you that you said I should teach you for 2 months, okay, what am I going to do under the contract? I'm going to be teaching you, right? I'll give you books. I will do an executive revision master class with you. Then I will assist you as well in your registration. So these are the activities I'm going to be doing. These are the performance obligations. The standalone price simply means if I'm teaching alone, how much am I going to charge you? Remember, I'm doing these 4 things for the $10,000 we have below here, for the $10,000. So if I'm teaching only for 2 months, how much would I have charged? Okay, maybe I could have charged $7,500. Follow me carefully. If I'm giving you only my books for the course you want me to teach you, that could be $300. If I'm doing an executive revision masterclass alone for a period of 2 months, that could be $3,800. And then if I'm assisting you in the registration of the exams alone, that is going to be, let's just say, $2,000. So these are the stand-alone prices. Now, the step 4, no, that is what we are doing now. So allocate the transaction price to the performance obligation using the standalone prices. It simply means that we will share this 10,000, which is the transaction price, to the performance obligations using the standalone prices. So we're going to be allocating it. So how do we allocate it? How do we allocate it, sorry? So we add all these up, and when we add it up, what do we get? 75 by 300 by 3,800 by 2,000, and that is going to give us 13,600. So you realize that if I was doing these jobs separately, Ebenezer, you said no sounds. Can you check your device? Because I think we have sound on. Anybody else facing sound challenge, please put it in the chat box if the sound is okay. Anybody facing sound challenge? Hello, Ebenezer, you can check your sound. Ebenezer still says no sounds. Anybody else having sound problem? Check your sound. I don't have sound problem. Ebenezer, check your device. Maybe your device has done something, but the sound is coming. Okay, Richard Ajay said, I can hear him. Yeah, so Ebenezer, check your sound. Check your device also, something like that. Okay. Bernard Cobbiner said, there is sound. Okay, so Ebenezer, check your sound. Maybe check your device. It could be a problem from your device. Okay, Foster Bashios also said, I can hear. All right, thank you very much. Ebenezer, you are still saying no sound. If there is no sound, please check your device because everyone else can hear me. So check your device. Joseph Udam said sound is okay. So Ebenezer, please check your sound. It could be your device or something like that because everyone else can hear me correctly or clearly. So step 4, we allocate the transaction price to the performance obligation using the standalone prices. So how do we share this 10,000 to these things? That is the allocation. So in the sharing, all we do is that when it comes to the teaching, it will be the 7,500 divided by the 13,600 times the 10,000. So 7,500 divided by the 13,600 multiplied by the 10,000. And that's going to give us 5,515 approximately. 5,515. So that is the allocation in relation to that. Ebenezer said the sound is not stable. Check your device, Ebenezer. Everyone is okay with the sound. Then if we allocate for books, that is going to be 300. And that we're going to have 221, the allocation. Then with the executive revision masterclass, 3,800. And we're going to have you can punch these out as well yourself so that we confirm. 2,794. And then the final thing, assisting you to register. That should be 2,000. That'll be 1,471. So when we sum all these up, we should get the $10,000 in relation to that. Joseph Edu also said sound is better here. Okay, so Ebenezer, you check your sound. So this is the 4th step. So this is what we are interested in. Okay, this one. This is what we are interested in. The allocation of the transaction price to the performance obligation using the standalone prices. Okay, so Foster Basho said, please, can you repeat the calculation again? Okay, so step 4, we are saying that allocate the transaction price to the performance obligation using the standalone prices. So our transaction price with our illustration is this $10,000 we have here at the bottom right corner. And the performance obligations are teaching, books, executive revision masterclass, and then assist in registration. Then the standalone prices for these, will be equal to, Lindelwa said, please also show how the journal entry will look for this transaction. Yes, I'll be doing that. That will be in the step 5, so don't worry. So these are the transaction prices respectively. So if we know the standalone prices, if we were doing these separately, this is how much I'll be charging for them separately. So now we will share this $10,000, the transaction price, to the performance obligation using the standalone prices in relation to that. John Edu said, please, would the standalone prices be given? Yes, always in the exam hall, the standalone prices will be given. It is the transaction price that you would have to calculate based on the way the question will be structured, but the standalone prices will always be given. So Foster, once we get the total, we add all these up and we get 13,600. Now we will allocate. So the way we get this 5,515 is 7,500 divided by the total of 13,600 multiply by this 10,000. Are you getting it? That is what will give us the 5515. And we do the same thing for the books. The books will be 300 divided by the 13,600 multiplied by the 10,000. And that will give us the 221 approximately. So you can confirm the workings as well and see. Foster Basius, are you okay? Let me know if you are okay. All right, Foster said he is okay. So this is the step 4. So once you are able to compute your transaction price at the bottom right corner here, you are able to add up your standalone prices for the performance obligation. You now allocate it, and now this is what we are going to be having as an organization on the step 4. So you note it down and let's go. So if you have any questions, put them in the chat box. Okay. So now that we come and we have all of these, please keep these figures in your mind, especially the standalone prices. Sorry, the computation we just did in the yellow circle. I did a screenshot of mine. So let's go to step 5. Step 5 is recognize revenue as and when performance obligation is satisfied. That is step 5. You recognize revenue as and when performance obligation is satisfied. So recognize revenue as or when performance obligation is satisfied. So it means here we'll be recognizing revenues in stages. As and when I do any of these performance obligations, I'll be recognizing the revenue in relation to that. Now, it is this step 5 that leads us to something very important we need to understand. When it comes to the revenue recognition at the 5th step, you have to put in your mind these two things. That revenue can be recognized at and revenue can be recognized over. When we say revenue is recognized at, what do we mean? It means the revenue is recognized at the date of the contract, at the signing of the contract. So at the commencement of the contract, what revenue can we recognize? That is what we mean by recognition of revenue at. Then recognition of revenue over is the revenue we can recognize over the life of the contract. So looking at the illustration we are having here, it's a 2-month deal, right? And at the signing of the contract, what can we recognize as the revenue? The day you come to me and say, Nhyira, I want you to teach me for 2 months. And I said, okay, I'm going to charge you $10,000. I might not start doing anything, but that day I may have given you the books. For that reason, the cost of the books or the revenue allocation we had for the books, 221, will be recognized at, okay, at. Then the rest will be recognized over the period of what? 2 months. So that as and when I fulfill, as and when I satisfy the performance obligation, I will be recognizing the revenue in relation to that. So when it comes to the 5th step, recognize revenue as or when performance obligation is satisfied. You can recognize revenue at the date of the transaction. What have you done? Then you recognize it. Then over the life of the transaction, you are going to be recognizing that as well in relation to that. So these are the 5-step framework you must understand when it comes to recognition of revenue. Now, someone asks about the journal entry. So let's say, for instance, you paid me the $10,000. So how do we account for it? Now, when we receive the whole $10,000, we will debit our cash. So we debit cash, or maybe you paid it directly into our bank with the 10,000, and then we will credit what is called the deferred income accounts. Okay, deferred income, because it's an income that has to be deferred and then recognized as and when a performance obligation is satisfied. And there are times where instead of deferred income, we can say you credit the contract asset account. Okay, that is also another way to recognize it in relation to that. So as and when a performance obligation is satisfied, all we would just do is to debit now the deferred income account, and then we will credit our revenue. That's it about that. We debit the deferred income account and credit the revenue. But as always, at the reporting date, this deferred income, DI, the deferred income, must be splitted into the current component and then the non-current component. Okay, we must split it into the current liability and then the non-current liability. Why is it a liability? Because we receive money, but we have not fulfilled. We've not finished doing the work, so it's a liability. So the one that is receivable, the portion of the deferred income that is receivable in the next 12 months will be recognized as a current liability. Then the portion that will be more than 12 months will be recognized under non-current liabilities. So Lindelwa, I think you asked about the journal entry. That is how we go about it. And these are the 5 steps we follow in the recognition of revenue under IFRS 15. Any questions, please? I'm taking some questions on this so far. So if you have any questions, put it in the chat box. Okay. So I guess we are okay with everything here about that. Any questions? Any questions? Okay, so Bernard Kobana said good. All right, so you are okay. That's awesome. Rubin Bologna, good evening. I believe you are also doing well. Linduela said, can you please repeat the last part about splitting the deferred income? Okay, so I said that the whole 10,000 that we received, we may not be accounting for it for the period under consideration. For that reason, it must be splitted into the current component and the non-current component. The amount receivable in the next 12 months or within the next 12 months will be accounted for as a current liability. Then the amounts that will be receivable in more than 12 months will be accounted for as a non-current liability. Okay, so if the contract is such that it doesn't exceed more than 1 year, then certainly all of them will be classified under non-current liability. I hope you get it. The whole deferred income will be classified as not current liability if we expect that the contract will not exceed more than 1 year. But if the contracts will exceed more than 1 year, then the part of the activity that we know we will fulfill within 1 year will be recognized as a current liability. Then that part that will go beyond 1 year will be recognized as non-current liability. So, Lindwelwa, I hope you understand it now. Let me know if it is clear now. If it is not, let me know as well. Bernard Kobina said, hope deferred income can also be unearned revenue. Yes, we can say that. We can say that. Okay. Ruben Blonya said, I'm doing well, sir. Okay, we thank God. Lindwella said, got it. Thank you. You are welcome. Good. So this is the first aspect of this whole thing about IFRS 15. But remember I told you IFRS 15 is replacing 2 accounting standards. The 5 steps we've looked at here really is considering the issue about the IAS 18 aspect. So the IAS 11 aspect, which is the construction contract, how do we go about it? So let me take you through that briefly. Okay, so if an organization or an entity is undertaking a contract and the contract goes beyond 1 accounting year, like, how do we account for it? So like, if the performance obligation is transferred over time, then we need to look at how the performance obligation can be measured. So when it comes to dealing with construction contracts, this is where, for instance, I'm a real estate company, and then let's say Bernard comes and say, Nhyira, I want you to build a house for me. Then I said, okay, what house do you want? So Bernard said, all right, I want a 2-bedroom house. Bernard doesn't have much money now, so he wants only 2-bedroom house. So 2-bedroom house, maybe with a swimming pool, something like that. Maybe also with 2-car garage for he and the wife. So that is it. Then I looked at it as a contractor. Then I said, okay, Ben, I'm going to be charging you $400,000. That is how much I'm going to be charging you. So the question is, such contracts, how am I going to go about it? And then let's say that I'm going to be undertaking the contract within 2 years. Now, the reason it is taking 2 years is that maybe Bernard cannot pay the 400,000 at a go, so we spread it over. So that is why it's taking 2 years, because a 2-bedroom house can actually be built within the shortest possible time, actually. So let's say we're going for 2 years. So if we're going for 2 years like this, how do we account for it? There are steps we follow in dealing with such questions. The first step is to determine whether there is profit or loss on the contracts. Okay, so we calculate or we determine the profit or loss on the contracts. Now, how do we determine if the contract is going to yield profit or loss? It's simple. It's going to be the contract revenue minus the total cost to be incurred on the contract. That is what we mean by the profit or loss on the contract. Now, please follow me carefully here. Traditionally, we expect that every contract should be profitable. Note that when we say total cost here, we mean cost incurred to date, as well as estimated cost to completion. cost incurred to date plus the estimated cost to completion. So let's say that I'm going to do when there is profit, what we do, and when there is loss, what we do. So let's say we calculated the profit or loss on the contract and we get a loss. Now remember, I charged him 400,000, which means that possibly I speculated that maybe I'm going to be incurring a cost of, let's say, $320,000. So in my mind, I thought I'm going to make a profit of $80,000. But as we started working, the land that Bernard bought was a marshy area. There were a lot of water there, and there was also some rocks there. And so we needed to bring machines, we need to fill the place up, we need to refix the rocks, and we need to put a lot of rocks there. And so we didn't know that is how the land was. So we ended up incurring an extra cost, so that now we are expecting that to finish the 2-bedroom house with a swimming pool and two-car garages for garage for Bernard, we are actually going to be spending somewhere around $480,000. But we have already charged Bernard $400,000. Now, I don't want Bernard to say, Nhyira, then you didn't do your work well. Me, that's all my budget. I'm not going to do anything. So I don't want to bother Bernard, because I know when I treat Bernard well, Bernard will make a recommendation to Ruben or Linduelwa or to Foster, and they will also come and build, or they will employ me to build their house for them. So I'm going to take this 80,000 up as my own loss. The standard states that when a contract, a one-off contract like this is having a loss, then the loss should be written off in the first year of the contract. Please listen to that very well. That is a principle. I said, if we calculate the profit or loss on the contract and we end up making a loss, the standard states that the loss should be written off in the first year of the contract. No apportionment, no allocation. The total loss should be written off. So I am making a loss of how much? $80,000, because I'm taking Bernard 400,000, but I'm incurring a cost of $80,000. So I'm making a loss of $80,000. The standard states that that loss on onerous contracts will be recognized as an expenses in the first year of the contract. I hope you get the principle. Okay. The next thing is, if assuming we made a profit on the contract, then that profit and the contract revenue has to be allocated over the life of the contract. Let me take that again. If we calculated, so this time around, there is no 480 anywhere. It is correct, 400,000. We will expect to incur a cost of 320. So we are actually going to be making a profit of around $80,000. It's a good news for us. Then this contract revenue of 400,000 and this profit of 80,000 must be allocated over the life of the contract, which is what? 2 years. The question is, how do we allocate it? That is where we come to the step 2. So step 2, and that is the allocation of contract revenue and profits. So how do we allocate the contract revenue and profit? We allocate the contract revenue using, so the standard says that we allocate the contract revenue using the percentage of completion. Make sense? We allocate the contract revenue using the percentage of completion. Using the percentage of completion. So we allocate the contract revenue using the percentage of completion. Now, how do we compute the percentage of completion? I want you to follow me carefully here. There is what we call the input approach and then the output approach. The input approach and then the output approach. So look at it carefully. Let's look at if we are using the input approach. If we're using the input approach, then our percentage of completion will be equal to the cost incurred to date divided by total contract cost times 100%. This is the input approach. We are using cost incurred to date divided by the total contract cost times 100. Remember, I told you the total contract cost is the cost incurred to date plus the estimated cost to completion. If we are using the output approach, on the other hand, then the percentage of completion will be equal to work certified divided by contract revenue times 100. Work certified divided by contract revenue times 100. It depends on the question and which method will be used. So it is what you have available in the question that will determine whether you are going to be using the input approach or the output approach. Now, work certified simply means the value of the good of the work that has been done so far. So when architects comes, when experts come to look at the work that we've done so far. So we are building a 2-bedroom house. Maybe we've finished with the foundation, we've constructed the swimming pool. So how much do we value that? That is the work certified in relation to that. So that is the second step, we allocate. So when we now calculate the contract revenue, when we calculate the percentage of completion, so let's say, for instance, let's just come up with something. So let's say that the percentage of completion, maybe we computed and it is 30%. So how do we allocate the contract revenue and then the profit? Simple. So this is where the income statement comes in. So this is the income statement. I'm going to put my $sign up. We'll bring the profit. Okay. We'll bring the revenue. Then the balancing figure will be cost of sales. Remember, the profit and then the revenue will be allocated using the percentage of completion. Remember, in our illustration, we got a profit of 80,000. So we take 30% of the 80,000, 30% of 80. Okay, how much we got? So 0.3 by 80, that's 24,000. Then the revenue, we take the contract revenue, which was 400,000. We take 30% also of that. So 400 by 0.3, that's 120. So the balancing figure, so 120 minus 24 is 96, and that becomes the cost of sales. This is how we prepare the income statement if we made a profit. If we made a profit. Then we look at, so this is what we would have done if we had made a profit, right? But if the contract was a loss, remember what I said, the loss will be written off in the year that we are starting the contract. Simple. The loss will be written off in the year that we are starting the contract, all of a sudden in relation to that. Then The revenue recognizable, listen carefully. The revenue we recognize if the contract is a loss will be equivalent to the cost incurred to date. The revenue to be recognized if the contract is lost is equivalent to the cost incurred to date. So that is how we deal with the income statement for contracts as well in relation to that. How about the statement of financial position? And that's the final aspect. Any questions? Please put it in the chat box. I see a comment from Ruben. Ruben said, kindly explain the treatment and presentation of identified assets in the financial position of a lessee and lessor respectively. So your question is in relation to IFRS 16. Okay, so that is an accounting standard you guys have mentioned as well, and I'll be looking at it. Remember I said all the standards you've listed, there are videos on it on my channel. So if you check the playlist, Accounting Standard Series, I have lecture videos on almost all the standards. Okay, I have lecture videos on almost all the standards. So after the stream, you can check that playlist, Accounting Standard Series. As of today, we have 44 videos in that playlist. It covers all the accounting standards very well in relation to that. So for the statement of financial position, we must have what is called a contract asset or liability. Contract asset or liability. So how do we go about that? The pro forma is that we are going to bring the cost incurred to date. So bring cost incurred to date. Then we will bring recognized profit or loss. So if it's a profit, we add. If it's a loss, it is deducted. Then we bring the work certified or contract invoice. Let me do a shortcut. Work certified or contract invoice. Another name for the work certified is contract invoice. That's deducted. The balancing figure will be a contract asset or a contract liability. If it is positive, it's a contract asset. If it is negative, it's a contract liability in relation to that. And that is what goes to the statement of financial position. So when we talk about IFRS 15 in a nutshell, this is what we are talking about. Any questions so far? Any questions? Any questions? Any questions? I believe you understand. Especially for those of you who raised concern about the standard. Linduelwa, Richard J, Ebenezer Arta, Francis O2. Yes, so you guys raised a concern about that. Please, can you go over the calculation again? Which calculation, Ebenezer, to be specific? Is it the income statement or the contract asset or liability aspect? Ruben said, please go over again. Go over which one? Is it the income statement or the contract asset or liability? Please state clearly. Richard J said, I'm okay, sir. Okay, Ruben said the contract asset. So the contract asset or liability, we bring the cost incurred to date, which will be given to us in the question all the time. Then the recognized profit or loss, which we got from our step 2, calculating the percentage of completion and then allocating it in relation to that. Then we bring the work certified or contract invoice. That is how much that the customers is supposed to pay me. So how much Ruben is going to pay me for how much work I've done so far in relation to that. Then the net figure, if it is positive, is a contract asset. Then if it is negative, it's a contract liability in relation to that. John Edu said the financial performance, FP can be financial performance. Okay, so in the second line, all right. So we recognize the revenue because our contract, I'm assuming that I'm charging Bernard $400,000. And we said, let's assume the percentage of completion is 30%. So we take 30% of the contract revenue, and that is the revenue we recognized for the year ended under consideration. Then the recognized profit is going to also be 80,000 because we said the contract revenue was, say, 400,000 and the contract cost was 320. So the profit is 80,000. So we take 30% of the 80,000 and that's 24,000. So we subtract, when we look at the balancing figure, this is supposed to actually be in bracket. The balancing figure is going to be the cost of sales. So if you check it out, 120 minus 24 will give us the 96,000, and that becomes the cost of sales in relation to that. Okay. Ebenezer, I guess you are okay as well. Then the final thing, I think I forgot this, is the trade receivable. Trade receivable is simply the work certified minus cash retained. The trade receivables is the work certified minus cash retained, or if you want, the work certified minus the cash received. Why is the trade receivable there? Because so far, architects will say that I have undertaken the contract and the value of the contract I have undertaken, it's, let's say, $15,000. That is the work certified. But the customer will not give us the whole $15,000. That is the invoice we give to the customer. He won't give us all. So he may retain maybe 20% of that. If he retains 20% of that, then he will give us 12,000. What it means is that now the customer is owing us how much? $3,000. That $3,000 is what is called the trade receivables, and that goes under the current assets in the statement of financial position in relation to that. So that is also something that you have to consider and look at. Okay, so John said, oh, I'm okay, sir. And then Ruben said, it is okay now. All right. So this is what we mean by IFRS 15. So let's look at the next one, and that is going to be IAS 12. IAS 12. I think there are a lot of people who also raise query about the IAS 12. If you have any questions, please put it in the chat box. I'm going to be answering all of your questions. If you have any questions, you can put it in the chat box. So let's go to IAS 12. It's one of the fundamental accounting standards. Okay, so IAS 12, income tax. This is one of my favorite accounting standards. Income tax. So when we are talking about income tax, this is what we are talking about. So let's say, for instance, I present you with a pro forma and I say that profit before tax, PBT, it's, let's say, $600. Then we say tax rate at 30%. Let's say I put there $220. So we say profit after tax part, it's $380. Follow me carefully here. Now, you're gonna say, Nhyira, why do you have that? If you made a profit of $600 and your tax rate is 30%, then the tax we are supposed to put here is supposed to be $180 and not $220. The question is, why didn't we do 30% of the 600, but we are writing a different figure there, 220,000? The reason is that anytime you see the income tax in the income statement of an organization, it actually entails, among other things, 4 components. Listen to this carefully. So the tax figure you see here actually entails 4 components. The first one is the current year tax. So the provision for the current year tax, that's the first component. The second component is the over or under provision of tax. Over or under provision of tax. Third, it's going to be the deferred tax for the year. And then fourth, movement in deferred tax. So the figure you see here, 220, is actually an addition of these 4 components: the provision for the current year tax, the over or under provision of tax, the deferred tax, as well as movement in deferred tax. It is the net of these 4 that was written, or that is always written, in the income statement. So I want you to be careful and understand this very well. Ruben said, I want you to systematically explain deferred tax to me and its possible treatment in the various statements. Okay, yeah, that's what I'm doing systematically, so you understand it well. So if these are the 4 components that actually constitute the tax figure recognized in the income statement, what do we mean by them? So let's take them one after the other. You ready? The first one is the current year tax. We don't have to think a lot about the current year tax, because every time the provision for the current year tax will be clearly stated in the question. So for the provision for the current year tax, no P, it will be stated in the question. So usually the provision for the current year tax in the context of this question would have been what? This 180 here in relation to that, and we don't have to think about that. So the current year tax is not an issue. It will always be available in the question. But the second component we have is the over or under provision of tax. Over or under provision of tax. Let me explain that in detail. Now, when we say over or under provision of tax, what do we mean? So let's see. Now, every entity actually pays tax 1 year in arrears. In other words, the tax for 20x6 will actually be paid in 20x7. But in the financial statement of 20x6, the entity will make a provision. Sorry. So let's say the entity makes a provision that, oh, we will pay a tax of, say, $2,000. But the tax authority comes and the tax authority says that, no, the tax due us is not $2,000, but rather should be $2,800. What does that mean? It means there is an extra tax obligation that we need to pay for, which we have not provided for, of $800. So this $800 is called under provision of tax. Listen to this carefully. Under provision of tax. So with under provision of tax, it results into more liability. So in the trial balance, when we see over or under provision of tax, and it's on the credit side of the trial balance, that means it is what? Under provision of tax. Because we provided for 2,000, but we actually paid 2,800. So we have under provided for tax of an amount of what? $800. But let's flip it up. Let's say that we made a provision of, say, $3,000, but the tax authority came and said, oh, Nhyira, you did well, but your tax due is $1,007. Listen to this carefully. So what is the difference here? So there's a difference of 1,300. In this case, what has happened? Our tax liability has what? Reduced. And if you provide for something and you pay less than that, it's an asset. It's an income you are receiving in relation to that. So this is called over provision of tax. Again, if you see over and under provision of tax, and it is on the debit side, that means that that is an over provision of tax in relation to that. And this one will reduce our current tax payable, whilst the 800 will actually increase our current tax in relation to that. So this is what we mean by the over or under provision of tax. I believe you understand well. Very, very important. It's one of the things that actually trick students. So make sure you understand what they are. So if it is in the trial balance on the credit side, it is under provision of tax, it increases the liability. So once it's on the credit side, when you are opening your tax account, you bring it to the credit side of the tax account, or you add it to the current year tax provision. But if it's on the debit side, that means that it is an over provision of tax. For that reason, it reduces our current year tax payable. So if you open your tax account, you bring it to the debit side because it's on the debit side, or you deduct it from the current tax payable in relation to that. So that is what you have to understand when we talk about the second component of the tax figure that comes in the income statement, over or under provision of tax. Any questions so far? Everybody okay? All right. So let's move on to the third component. And the third component is where the journey becomes interesting, and that is to talk about deferred tax. So let's go there. So deferred tax. So Ruben said, I'm following. So far, it is okay. Awesome. So when it comes to deferred tax, what is deferred tax? Deferred tax is simply the tax consequences of a future transactions. Okay, meaning that something is possible, something is likely to happen in the future, and that thing may result to us paying tax. But we don't want to wait till the future, so we make the tax provision on that particular thing now. Now, why deferred tax? Deferred tax comes in because the way the tax authority accounts for transactions is different from the way the entity accounts for the same transaction. Now, when I say transaction here, I am talking about issues such as assets, okay? Issues such as acquisition of shares or investment. I'm talking about issues such as trade receivables, trade payables, and all other things. But I'm going to be using the assets as a benchmark to give the explanation here. When it comes to the accounting for the assets, the tax authority is interested in the tax base of the asset. Now, how do we get a tax base? The tax base of the asset is simply equal to the cost of the asset minus capital allowance. Because the tax authority doesn't know depreciation, what they know is going to be is capital allowance. So if it is capital allowance, that means from the tax authority's perspective, they are going to be calculating the tax base of the asset. But the entity will also account for the assets differently using IAS 16 depreciation or an investment property or revaluing the asset. So the entity will be looking at the carrying value of the asset, or if you want, the carrying amount of the asset. And that's going to be the cost minus any accumulated depreciation. So you realize that the tax authority has a different way of accounting for the transaction, whilst the entity also accounts for the transaction differently. For that reason, there is always going to be a difference between the value of the assets in the books of the entity and the value of the assets in the books of the tax authority. The difference between the tax base of the asset and the carrying value of the asset is what is called the temporary difference. So the temporary difference equals the carrying value of the asset minus the tax base. So the difference between the carrying value, the value that we will have in our books, and then the value that the tax authority will have in their books in respect of that same asset, in respect of that same investment, is what we refer to as what? The temporary difference. Please note that the temporary difference can be positive or can be negative. So if your temporary difference is positive, listen to this carefully. If your temporary difference is positive, what it means is that the carrying value is greater than the tax base. But if your temporary difference is negative, what it means is that your carrying value is less than the tax base. It is this temporary value or temporary difference that leads to what is called the deferred tax. So let's build it up above. So if the temporary difference is positive, it means the carrying value is greater than what? The tax base. So when our temporary difference is positive, it leads to or it results into what is called deferred tax liability. Now, what is the meaning of that? I will explain that in a moment. And then if our temporary difference is negative, it results into deferred tax assets. So what is the meaning of that at the end of the day? What's the meaning of that? This is what it means. So in your books as an entity or in your books as a company, this is what is happening. You are saying that the carrying value of your asset is, let's say, $22,000. But when we go to the tax authorities book, when we go to the tax authorities books, we see that the tax base of that same asset is, let's say, 18,500. I want you to follow me carefully here. So in our books as a company, we are accounting for the asset as how much? $22,000. And then in the tax authorities book, they are accounting for the asset as 18,500. Right now, should we sell the asset, it means we will sell it at what? $22. So if we sell it at the $22, it means we will make a profit. That profit we will make is what is called a temporary difference. So that's going to be 22,000 minus the 18,500. And that leads to $3,500. So that is the temporary difference. Now, because now somebody will ask, are we going to sell the assets? No. But the standard requires that we provide for it. So since the temporary difference is more than or is positive, or our carrying value is more than the tax base of the asset, it results into what is called deferred tax liability. So our deferred tax liability will be equal to the temporary difference times the tax rate. The temporary difference times the tax rate. So the reverse of this is true. Assuming we are valuing it at, say, $15,000, and the tax authority is seeing it as $17,000, then it means if we sell the assets now, we are going to make a loss, isn't it? We will make a loss of $2,000. In that case, we need to claim tax deductions from the tax authority, and that will be a deferred tax asset, a deferred tax asset. So this is how we deal with the deferred tax asset, or this is how we compute the deferred tax asset and deferred tax liability. Are we okay so far? Everybody good so far? Everybody good so far? So what will be the double entry now? What will be the double entry? So the double entry is simple. Okay, Pa Willie giving a thumbs up in the group. All right. So meaning we okay so far. So what will be the double entry here in relation to that? For the deferred tax liabilities, we are going to be, Ruben said, good. All right. So for the deferred tax liability, we're going to say that because it is a potential liability to be incurred, we're going to be debiting our income statement, okay, and credit deferred tax liability. And that goes to the statement of financial position in relation to that. That goes to the statement of financial position. Please note that even though I am saying debit the income statement, we are technically not going to be debiting the income statement because this deferred tax will actually be taken into consideration in the income tax account, because remember, it is the net figure of the income tax that we actually take to the income statement. So even though I've written here debit income statement, technically it is increasing our tax liabilities, and so it will be included in the current year tax chargeable in relation to that. But that is the double entry. We debit the income statement because it's an expenses, it's a liability to be incurred, and we credit the deferred tax liability in the statement of financial position under non-current liabilities. So note that always the deferred tax liability goes under or goes into the statement of financial position under the non-current liabilities. Because if it is an asset, we flip it over. And so flipping it over will mean what? We will now debit deferred tax asset, right? And then we'll credit the income statement. Okay, we credit the income statement. So we debit the deferred tax asset and we credit the income statement. I guess you may not see this part. So we debit deferred tax asset and then we credit the income statement. Okay, that is if it's an asset. But remember, like I said, technically, we are not going to be crediting the income statement directly with that. Rather, we are going to be netting it off in the tax calculation so that we get a one-liner figure to be taken to the statement of financial position in relation to that. Any questions so far? Ruben, you mentioned systematic explanation of the deferred tax and the treatment in the various statements. I believe you are okay so far. Okay, Richard J said, yes, please. Everybody good so far? Let me know in the comment box if you are good, or in the chat box if you are good so far. Okay. Now, another thing about deferred tax I want to talk to you about is when an entity revalue assets. And I want you to get this very well. So make sure you follow me well. When an entity revalue assets, there is going to be a revaluation gain. And let's say there is a revaluation gain. And the examiner says we should compute deferred tax. How do we go about it? And you got to be careful about the treatment of this very, very well in relation to that. So I'm going to be explaining that as well to you. If you have any questions, you put it in the comment box. So, revaluation of assets. John Edu said we will go over after the lectures. Oh, okay. So, revaluation of assets. So when we revalue assets and there is a deferred tax, what happens? How do we go about it? So look at what is happening here. For instance, the current value of the asset is, let's say, $2,000, and the company revalued the asset to, let's say, $3,000. And let's say that the written down tax base of the asset, it's let's say 1,007. So what is happening here? Be careful here. That's what I want you to understand. One, there is a revaluation surplus of $1,000, and you know how to treat revaluation surplus. We debit PPE, credit the other comprehensive income. But my interest is in the tax. So our temporary difference here will be equal to the fair value minus the tax base. So that will be equal to 3,000 minus 1,700. So the temporary difference in this case is going to be 1,300. Follow me carefully. Follow me carefully. So it means this will result into a deferred tax liability. So let's say the tax rate in the question is 25%. So let's get the deferred tax liability, and that's going to be 1,300 times 25%. So 1,003 by 25%, and that is $325. So that is the deferred tax liability. But how do we account for this deferred tax liability? Do we take the whole amount into the income statement, or we need to split it between the income statement and the other comprehensive income? Please take note of this because the examiner can punish you on this. Because there is a revaluation gain on the asset, so Richard AJ said, yes, I am good. I never understood this, but now I am okay. All right, that's awesome. So because there is a revaluation of assets, this 325 deferred tax liability, we cannot put all in the income statement. So it has to be splitted between the income statement and other comprehensive income. Because remember, this 1,000 revaluation surplus is going to go into the other comprehensive income. You know that, right? It's going to go into the other comprehensive income. But the question is, the tax figure, do we take all to the income statement? The answer is no. It must be splitted between the income statement and the other comprehensive income. But the question is, how do we split it? How do we split it? So I'm giving you a few seconds to write the illustrations down. So I will be cleaning it up. So we are assuming that the carrying value of the asset is 2,000. The company is revaluing it at 3,000. The tax base is 1,007. And so we are getting a revaluation surplus of 1,000. And the tax rate is 25%. So we are assuming that, we are saying that the temporary difference is going to be the fair value minus the tax base, and that is 3,000 minus 1,007. And so that's going to be 1,300. And so the temporary difference or the deferred tax liability will be the 1,003 times 25%, and that's going to give us 325. And I'm asking, do we take all the 325 to the income statement? The answer is no. It has to be splitted between the income statement and the OCI. So how do we split it up? So let's look at that. So our deferred tax liability, so DT liability in total is 325. We have to apportion part of that to the other comprehensive income, and that will be the revaluation gain multiplied by the tax rate of 25%. So that's going to give us 250. So the amount that goes to the OCI is the revaluation gain of the tax rate, and that's going to be 250. The balancing figure is what goes into the income statement as the deferred tax, and that's going to be 75. So this is how we split the workings when there is a revaluation surplus. Any questions so far? Any questions so far? Everybody good? Let me just cross-check the people who raised this concern. Linduelwa, Richard J, Joseph Udam or Udam. Everybody good so far? So that is the concept basically about how we deal with deferred tax in relation to that. Then movement in deferred tax comes in when we are dealing with the subsequent year. Okay, so Ruben said the splitting is clear. All right. I wanted to say something. It just escaped me. I wanted to say something. It just escaped me. Oh. Okay. I was talking about movement in deferred tax before I went to read the comments. Let me just continue with that. So I said the movement in deferred tax comes in when we are dealing with the subsequent measurement. Okay. So the movement, so in year one or the first year, we calculated the deferred tax liability and we got, let's say 200. That one, we debit the income statement, credit the deferred tax account. Then in the following year, we calculate the deferred tax again. So this is year one, this is year two. So in the following year, we calculate the deferred tax again, and we get something like 320. Okay, so the difference between the previous year and the current year is what we talk or we call, the 120 becomes what is called the movement in the deferred tax. Now, when it comes to the subsequent measurement, it is the movement in deferred tax that we account for in the income statement. When it comes to the subsequent year of deferred tax, it is the movement that is we account for in the income statement. So for the second year, when we are preparing the income statement, this 320 will go to the statement of financial position as the new figure for the deferred tax liability. Then this 120 is what we are going to be debiting the income statement with, and certainly credit the deferred tax liability in relation to that. So this is how we deal with movements in deferred tax. Okay, so Lindwalwa said, I honestly did not know about the splitting of the deferred tax liability. Really appreciate the tip. You are welcome. Ruben Blonya said movement in deferred tax. Ruben, that's what I'm on. I believe it is clear now. So with the movement, it comes when you are comparing one year to the other. So when you compare the previous year to the current year, the new deferred tax computed is what we take to the statement of financial position. The difference is what goes into the income statement. The difference is what goes into the income statement. Ruben said it is not clear. Okay, Ruben. I'm saying that, let's say the first year, our deferred tax is $200. Then in the second year, our deferred tax is $320. The movement is the difference between the first year and the second year. All right. And that is 120. That 120 is what will go to the income statement for the year two. That is the current year under consideration. Then the new deferred tax figure, which is the year two's deferred tax, that is what will go to the statement of financial position in relation to that. So Richard Ajay said, please, where does the 250 goes to? Are you referring to this 250 here? It goes to the OCI, the other comprehensive income. So in the other comprehensive income, if you bring your revaluation surplus as a positive figure, this 250 deferred tax will come there on the next line as a negative figure in relation to that. Ruben, are you not okay with the deferred tax? And then Richard J, are you okay now with the 250 treatment? Everybody good now? Richard J, Ruben, are you okay? Okay. So Joseph Udam said, thanks for the explanation. You're welcome. Okay, Joseph said, I'm good. All right, that's awesome. Any questions for me? So basically, when it comes to treatment of tax, especially in the level 2 financial reporting, these are the things you have to understand. So remember the 4 things I mentioned. Anytime you are looking at the financial statement of a company and you see income tax, it is not the tax rate of the profit before tax. It entails the 4 things: the current year tax provision, over or under provision of tax, deferred tax, and then movement in deferred tax. So this is also how we deal with IAS 12, income tax. Certainly there is a deferred tax issue about share-based payment in relation to that. Ruben said it's okay. And that is for financial reporting students on advanced level. Sorry, corporate reporting students for the advanced level in relation to that. And probably I will talk about that the next time, tomorrow, God willing, in relation to that. So I'm going to be concluding here today on our discussion. So we focus on 2 core accounting standards today: IAS 12, income tax, and then IFRS 15, revenue from contracts with customers. There were other standards that you guys spoke about, like the IAS 13, fair value measurement, IAS 16, property, plant, and equipment, IAS 23, borrowing cost, IAS 36, impairment of assets. I'm going to be discussing these with you tomorrow, God willing. So tomorrow we will continue with the financial reporting standards as well in relation to that. But like I said, you can check the channel page and you check the playlist titled Financial Reporting Standards. Financial Reporting Standards, or I think Accounting Standards series rather. Let me check. Yeah, Accounting Standards series. As of today, there are 44 videos in that playlist, and it covers almost all the accounting standards, So you can stay glued to that playlist, get all the videos there, and watch them over and over again, and you should be able to get the principles there. But tomorrow, God willing, we are going to be continuing with the discussion on the accounting standards, and I'm going to be touching on the rest of the standards you guys have mentioned in the comment box in relation to that. So any other comments, any other questions for me, you can put it in the chat box and I'll be replying to them all. So you can put them in the chat box and I'll reply to them all in relation to that. So John Edu said, thanks. We want to write the exams fast. If not, we will forget most of the things learned so far. Yeah, John, that is something that everyone is wishing for, because people say when they learn and the exams doesn't come early, you forget. So that is also there, but you just have to keep learning. You know, what's happening is all because of the coronavirus, and now they are thinking about opening schools and others in relation to that. So we just have to look at how it all goes. Certainly the CA, the Institute of Chartered Accountant, is making steps or taking steps to find out whether the exams can be held or whatever it is. So we will see how that turns out. But all I would say is continue to learn. Don't say you will forget. Okay, there is no way you forget. All right, I know you have a lot doing, you have a lot to be thinking about, but there is no way you forget. There's no way you forget. Linduela said, at what time tomorrow? At the same time, 16:30 GMT or 4:30 p.m. Ghana time. So 16:30 GMT or 4:30 p.m. Ghana time. So the same time, 4:30 p.m., we will continue with the class. Lindwela, where are you from? I just want to know where you're from. Okay, Ruben said, we won't forget, Kra. Yeah, very, very important. You can't forget. All right, you can't forget. So just keep learning, keep working hard. That is why I said, I don't want you to learn this with Baba. Okay, because when you chew the Baba, it's not going to work. The Baba will not work. When you chew the Baba, you forget it easily. Rather, if you understand the concept very well, even if you put it aside for some time and you come back to it, the concept is there. So when you pick it up, you can quickly go in relation to that. So keep working hard and keep pushing and keep studying. That is why I'm holding this live sessions with you almost every day. I'll be trying to come your way in relation to that, so that I will be able to assist you, because if you are learning alone, it gets bored. But if I can come your way and then answer your questions for you and assist you and help you in the key areas, it keeps you focused and it keeps you studying and it keeps you working hard in relation to that. Okay, so Lindwelwa said, okay, South Africa, all right. Okay, that's fine. So I'll be coming your way again tomorrow, 4:30 p.m. or 1600 GMT, 1630 GMT, as we continue with our financial reporting standard in relation to that. Two key things I want from you. Number one, I want you to keep studying, keep working hard, keep solving a lot of questions, keep practicing a lot of questions, so that these concepts will be familiar with you. You'll be able to understand it very well. And then number two, I want you to make sure that you share our channel with your friends, your colleagues, and the people you know on your WhatsApp platforms, on your Facebook pages. Just share it with them so that we'll be able to reach as much people as possible, because there are many students across the country, across the continent, who are studying and who will need materials like this. So help us so that we can help a lot of people across. So share the channel, share the videos, and share it with others so that we can have more people joining the stream and being with us and learning under my mentorship as I assist you in order for you to study well and prepare well for your examination. So thank you very much for taking time out to be with me. Richard Foster, Ebenezer, Francis Otu, John Odu, John Edu, sorry, Lindwelwa, Richard Opoku, Ajiman, Joseph Udam, Bernard Kobana, um, yep, I guess all of you guys, all of Ruben Bologna, and everybody else who watched and did not give any comments as well. Come on, everybody. Thank you very much for taking time all the time. It's a privilege to come your way all the time, because if I come and nobody is watching, it doesn't make any sense. But thank you for every time being with me on the stream and studying under my mentorship. I wish, and it is my prayer, that these streams that we are doing will be able to answer a lot of questions you are having, and most importantly, help you to study very well so you can pass your exams. At the end of the day, that's my objective. I want you to go into the exam hall with the confidence and write the exams, come out with a smile, and when your results come, you will boldly be able to see your results, check your results, and you have passed with flying colors, and you can take your life to the next level in relation to that. So that's my prayer, that's my desire, that is my ultimate goal. And it is my prayer that as we do these, God will shower his rain of blessings on it, so that really it will bear fruit and we will become successful in the near future in relation to that. So thank you very much. I'll see you same time tomorrow, 4:30 p.m. or 16:30 GMT, as we continue with our discussion on the Executive Revision Masterclass, focusing tomorrow as well on the financial reporting standards. So we'll be looking at the some of the IASs again and the IFRSs again tomorrow in relation to that. So thank you, Miriam. Oh, Miriam, so you were watching as well. Thank you very much. Today I was behind the scenes. All right, Miriam. Okay, thank you for being behind the scene as well. I believe you are preparing as well for your exams. I guess you're writing financial reporting. Okay. So good night. Take care of yourself. Now remember, coronavirus is still there, right? So make sure you sanitize your hand. Make sure you keep social distancing and you wear your face masks and your nose masks when you go out, and stay safe. All right? Stay safe. If you cannot stay home and you're going out, make sure you put on your face mask or your nose mask and you sanitize your hands very well in relation to that. Okay. So Lindwell said, thank you. Very informative session. It's a pleasure, and I'll see you same time tomorrow. Bye-bye.